With that notification, we can officially get started. So welcome to today's webinar entitled Investments. It's a component of our larger fiduciary training program that we have at Multnomah Group that we use with clients and committee meetings to talk through issues that are pertinent to the committee discussion and due diligence process. My name is David Williams, and I'm a senior consultant and also serve as the director of our investment services team here at Multnomah Group. I'm joined today by my colleague, Scott Cameron, and I'll let Scott go ahead and introduce yourself.
I'm Scott Cameron. I'm a principal and member of the investment committee here at Multnomah Group and consultant similar to David.
Great. So we are obviously conducting this webinar via Zoom. There is a Q&A button there at the top. Feel free to use that, and we will attempt to address questions as we go through the session or at the end. We will be recording the session, as obviously was stated there at the beginning, and we will send a link to all of those that participated and registered for the session in the days following the presentation today. With that, let me go ahead and get started. Starting on slide 2 with a discussion of the fiduciary training program. So this deck is part of a larger effort that Multnomah Group has put forth in developing a comprehensive fiduciary training program. The words on this slide are important in the sense that the Department of Labor really expects that committee members will continue to educate them about themselves about their roles and responsibilities. And as part of that ongoing education requirement, we hope that you walk away from this discussion today with a better understanding of your responsibilities as serving on fiduciary committees with regard to the selection and monitoring of investments within your defined contribution plan, as well as an understanding of some of the terminology that we use in the investment industry. So we're going to try and distinguish between words like investment strategy, management technique, and style that we often throw around, whether in conversation or in our written materials. And then we'll talk a little bit about the tools and techniques that we use to help you monitor the investments that are offered to your participants within your defined contribution plans. Scott and our goal in this discussion is to really hopefully provide you with a little more comfort around some of the technical jargon that we in the industry have created to describe different types of investment products that may be offered to your participants. With that, let's start with a quick discussion about your responsibilities as a committee member related to investments that are offered. I think it's, first and foremost, it's important to acknowledge that retirement plans are complicated. And you really aren't expected to know everything, whether it be about investments, administration, compliance, vendor management. There is a lot that goes into those different areas. And the expectation is that it will continue to evolve and potentially become more complicated. And ERISA is really clear. ERISA being the Employment Retirement Income Security Act of 1974, we shorten that to ERISA. That's the governing law from a fiduciary standard practice with regard to your responsibilities for the retirement plan. But it's that set of laws are very clear that where you lack expertise, the expectation is that you're going to hire outside help to help you fulfill those duties that are your responsibilities under the law. So the next set of bullets here just really talk about what are those responsibilities. And so once you've decided that you're going to hire, now we're going to step one is we're going to follow a prudent process. And a prudent process we'll talk a little bit more about as we go through this. But essentially, what you're going to be held to account for is how did you determine to offer said investment? What was the process that you went through to select that investment? What was the process you went through to monitor its performance throughout the years it was offered in your plan? Next item there is develop and maintain an investment policy statement. There's no requirement under ERISA that you have a written investment policy statement. The important part here is that once you do decide to document how investments are going to be selected and monitored, that you follow that document, and it's a living document. We're going to review that on a periodic basis to ensure that it's staying current with best practices. The next item is probably where we spend maybe a lot of time, but also maybe the more complicated subject that you as a committee will face when thinking about investments. It's really determining the structure of the investment menu. And by that, we mean not just a laundry list of investments, but how are those investments thought of in a cohesive way? So we like to think of this as in a tiering structure. So we group investments by type. So we may group the target date funds in a tier 1. We may look at a core set of options that are low cost building blocks in tier 2, and then a more broad set of investment options that are still within kind of the stocks, bonds, and cash categories, but may have some more nuanced approach to how those investment managers are approaching their designated markets. So that's an area that we spend a lot of time on, and really is an important one because you want to offer enough selection to satisfy maybe your most sophisticated or your investors with the most time or interest, but also you want to make sure that the investment options are presented in a way that they don't overwhelm those that just want simple turnkey solutions when it comes to investments. Once we've determined the investment menu, then we're going to fill out that investment menu through the selection of investment options. We talk about default and core options. Those are really, default options being those for options for participants that don't want to actively make a choice. Typically, those are the target date funds. They're going to be multi-asset class and become less equity focused as time goes on. So they might de-risk would be a term that's used as time goes on. And then the core investment menu, again, that broad set of single asset class options. And then finally, the managed account provider is a product that's offered within many defined contribution plans where a participant would turn over the management of their assets to an outsourced provider. Once we've selected, we're going to monitor. Typically, that's done on a quarterly basis and maybe less frequent than that. But you're going to monitor at regular intervals. And the importance here of monitoring is you're checking how are those managers done relative to the criteria that you've established, if you've established an investment policy statement, so that you can, again, fulfilling that duty to not just select, but to monitor on an ongoing basis. And then finally, every once in a while, there will be a need to replace an investment option, whether it be because of performance, a change in a manager's organization, just a regular review provides a better option, or you've made a change to the investment menu. That happens from time to time where you may decide we want to offer more passive options or more active options, or we want to offer participants the ability to invest based on their social criteria, and so we decide to offer environmental, social, and governance options. So from time to time, you may make some additional changes to your investment menu as a result of additional categories that you want to offer. Talked a little bit about this already, but the prudent process with respect to investments. So one of the things that ERISA is very, very clear on is it's really about the process that you go through in selecting and monitoring investments that is critical. There are certainly going to be concerns about poor performing investments, but really where you're going to hang your hat if ever challenged is what's the process that you as a committee go through in order to select that investment option, and what was the process that you used to monitor that option. So with regard to kind of all projects that you as a committee might face with a fiduciary kind of hat on, we're going to approach it in kind of this 4-step process. So we're going to gather information. We want to understand how participants are using the investments currently and how those are being communicated to participants. So that's our first step. Then we're going to analyze the information. We're going to analyze that utilization data. We're going to analyze the suitability of a specific investment option. And then we'll prepare a report. We'll get together as a committee and we'll meet and discuss that information, ultimately making a decision with regard to investment option A or B and what's most appropriate fit for your plan and the objectives that you've established. And then the last step is a really critical piece of the process, which is that we need to document the 3 steps that happened earlier. If we don't create that documentation, whether that be a report or the minutes from the meeting in which a decision was made, 3-4 years down the road, we won't remember how and why we came to the decision to offer investment option A versus investment option B. So it's really, really critical that the fiduciary file, that documentation is ultimately maintained.
So as David had mentioned at the outset, I think, understanding what your responsibilities are as a fiduciary with respect to investments, one of the biggest challenges that we see with our industry broadly, and oftentimes with consultants and other advisors working in this space, is the complexity of the language that's used. And I think that can be a barrier to fiduciaries fulfilling their obligations. So we're going to talk a little bit about some of the terminology that you may see, hopefully with the intent to maybe simplify or demystify some of these common terms that get thrown around. Because I think too often, the industry approaches this as, we want to use these complicated terms and make it sound important and really complicated so that you think we're really smart and you need us. And ultimately, that shouldn't be the goal. I mean, as the goal should be to educate those fiduciaries to understand the products that they're using and to make good, well-informed decisions. So, a couple terms that we see, actively discussed, and most often in our experience, there are investments of both types within an investment menu, are active investment funds and passive investment funds. So active basically just means that the portfolio that's being used is being managed by somebody with the goal of outperforming an index through decisions that they make to buy and sell securities. So I think when most people think of mutual fund management or portfolio management, they think of active management, somebody that's really smart, that's cracking open financial statements and looking and going to the mall and seeing which stores are busy, and you're trying to do the fundamental research to figure out which companies are going to do better than the broad market. Active funds are very commonly used within defined contribution plans. There are some challenges that come with them, and we'll talk a little bit about kind of evaluation methods and tools for evaluating active funds later on in the presentation. But typically what happens is you are paying as an investor in one of those funds higher fees to compensate a fund manager for the work that they do in trying to outperform whatever benchmark that they're managing the portfolio against. Conversely, you have passive funds, sometimes called index funds. And these passive funds, rather than trying to, through security selection or other methods, outperform a benchmark or outperform some sort of bogey that the manager is tracking, instead, they try to track the performance of a specific index. The portfolios are designed to mimic the performance of the index. And because they can do that, and they can do that using technology, and you're not paying for all of the fundamental research that goes into active management, passive or index funds tend to be lower cost than active funds, and benefit from greater scale because some of the fixed costs of building the index funds can be spread out over a larger asset pool. So at a high level, you're going to have an investment menu that has some combination of active funds and passive or index funds. There are cases where you may have only active or only passive, but in our experience, most investment menus have some combination of two of those investment types. As we look within the active realm or domain, you'll also see a lot of terms kind of bandied about for the way that the manager tries to add value. Fundamental analysis is one example. And again, back to kind of what maybe the common perception of active management is it's fundamental analysis. You have an investment manager that's looking at an individual stock's fundamentals, balance sheet, income statement, revenue growth, inventories and turnover, current valuation, and they're trying to determine if they think the company is worth more than the current trading price. You may also have technical analysis where they're looking at historical pricing patterns, trading patterns, and to try and determine whether there's an opportunity for a company to outperform or underperform. You also may have quantitative analysis, which is using computer models and algorithms to try and identify mispricings in the market. All of those techniques are individual kind of standalone options, but can be combined. Oftentimes you'll find a manager has some quantitative techniques maybe early in their process to narrow the universe of investment options, and then that will flow through into a funnel where they're doing fundamental analysis, or they add technical analysis to manage risk. A couple other terms that often get bandied about with respect to active management and also are not necessarily unique or distinct from those other terminology is top-down or bottom-up. When we think about top-down investment managers, we're really thinking with somebody that starts by looking at the broad world and using that to drive to individual investment decisions. So they may look at macroeconomic data based on country, based on industry or region. They may look at where we are in the business cycle, where we are from demographic trends, and they start wide and they draw down. So maybe they see an aging baby boomer generation and say that's going to have some impact on healthcare industry, and that's going to lead to a certain set of investments that they think are going to be attractive. That's kind of the traditional top-down approach to investment management. You also have bottom up, which basically kind of ignores those macro trends and starts with individual companies and looks at the fundamentals of those companies and makes decisions about securities based on fundamentals, regardless of what the broad industry economic data may perceive. Again, similar to fundamental and quantitative and technical, the ideas of top down and bottom up oftentimes get blended together by investment managers, but they're thrown around as terms to make it seem more complicated, the work that's being done than maybe actually is. I think most people, if they think about how their portfolio manager may look at making decisions, would have some expectation that they're looking at the broad economy and the industry data, and also looking at individual company data. So the idea of top down and bottom up are terms that are used, but aren't necessarily meaningful in terms of the overall evaluation. For index or passive investments, you also see some common terminology that gets used. The first is replication. And I think this is, if you think about an index fund, what most people think is happening. So basically, the idea of replication is that you look at an index, and probably the most common is the S&P 500 index, and that is basically 500 stocks, and it's market weighted. So the biggest company is the biggest weight in the portfolio on down to the smallest company. The idea of replication is that you're going to build a portfolio that matches the individual securities in the exact same weights as in the index. So if the S&P 500 has 500 stocks, you're going to own all 500 of them. If Microsoft is 4% of the portfolio, you're going to own 4% of your portfolio in Microsoft, all the way down to the smallest company in the index. The benefits of replication is it reduces the tracking error because you're buying the exact securities that are in the benchmark. In the exact weights, you're going to track the performance of the benchmark. The challenge is that it works in certain markets, highly liquid markets like large cap US stocks. It's not as successful in other areas of the market where indexing has become more prevalent. For example, in fixed income. So many fixed income or bond benchmarks use a different method of passive management that we would describe as sampling or sampling technique. If you look at a broad investment grade fixed income benchmark, it may own 3,000, 4,000 individual bonds. Those bonds don't trade on public markets the way stocks do, and they don't necessarily trade with the same frequency that stocks do. So if you were trying to have an index or passive fund that's tracking the bond benchmark or potentially a less liquid US or equity benchmark like small cap or international asset classes, you may find the manager uses sampling. So they look at the benchmark and they identify certain attributes of the benchmark that they think are indicative of how the benchmark may perform. And they build a portfolio that is designed in aggregate to have the same attributes as that benchmark, even though they may not own all of the same securities. Within a bond fund, for example, they may look at the overall yield, the maturity and duration of the portfolio, the sector allocations, the country distributions, the coupon rates. For a stock fund, they may look at industry weights, they may look at overall market beta, the sector allocations, market cap. Basically, they're trying to create something that, when it's all put together, looks as much like the index as possible, knowing that they're not going to own every single one of the securities in the exact weight. It can be a technique that's very helpful in trying to actually take a passive index, which is not investable, and turn that into a portfolio that you can invest in. But it does come with some additional risks where if you don't do that matching correctly, you may get performance that deviates from the benchmark. So as we look at these investment management techniques, I think it's important to understand that there are a lot of terminology that's used. Some of it is impactful to how a portfolio is maybe designed and implemented and the evaluation tools that you use. But if you break down kind of just the terminology that gets thrown around, I think it's typically easily understood by committees what's going on with a portfolio and how the portfolio is designed to be managed. A couple other terms that you may hear bandied about in an investment committee as well are large cap, mid cap, small cap, and I guess I am guilty of that as well. On the last slide, I was talking about large caps stocks. When we talk about caps or market capitalization, small, mid, or large, really we're looking just at the market capitalization, the overall size of the company, looking at the number of shares that are outstanding and the share price and figuring out how big that company is, how much it's worth. It's really hard to put specific numbers around what defines a small cap stock versus a mid cap versus a large cap stock based on overall market size, because over time, what used to be a small cap is maybe now, or what used to be a mid cap is now a small cap because the market has grown up. Typically, from an investment perspective, the way that I think most look at this is kind of based on just kind of ranking in size. So I mentioned the S&P 500 index is a very common index that's used of large US companies that basically looks at the largest 500. Mid caps, depending on who your definition is, may be somewhat overlapping in that or kind of just below that largest 500. And then small caps are kind of the next group down if you define it. So a common, and I think David will get into this, a common US benchmark system is the Russell indexes. Their large cap index is basically 1,000 largest companies in the US. The mid cap index is actually a subset of that largest 1,000, and the Russell 2000 is kind of the next set of companies, and those are generally defined as small cap. So you see a lot discussed around market cap size, large, mid, small. You also see discussions around investment style, value growth. And I think you combine large, mid, small with value, growth, and blend, which is just a mix of value and growth. And you get the traditional Morningstar style box view of equity markets. When we talk about value or growth, I think one of the challenges, those terms actually have distinct meanings. Stocks can be value stocks or growth stocks, and investment styles can be value or growth. So if we're looking at it based on a stock evaluation, typically what we would say is value is defined as companies that are inexpensive using some broad market benchmark. So a price to book, a price to cash flow, price to earnings type metric. If that is a low valuation, a low price to earnings, it would frequently be defined as a value stock. Using that framework, growth stocks often are just defined as anti-value. So they're not cheap, they're expensive. The market assumes that if they're not value, they must have growth attributes. That's why their price to earnings or price to cash flow is higher. So if we look at a stock analysis, you can look at it through that lens of value and growth. But if we look at an investment manager, you may also look at them through the lens of value or growth. And this is really focused on what the investment manager prioritizes in their investment process. Value managers typically are looking at underlying fundamental financials. They may look at the balance sheet, they may look at earnings, they may look at cash flow, and they're really focused on investing in companies that they think are trading at a discount to what they think the fair value of that company is. It could be based on its market cycle, it could be based on its peers in the industry, it could be based on its liquidation price if you were to break up a conglomerate into its parts. They're trying to buy something that they think today the market is it's trading in the market for less than its fair value. Growth investors, on the other hand, tend to look at the market and say, we want companies that have above average growth metrics, either compared to their peers, compared to some absolute benchmark. And we think long-term, if a company grows fast enough, will be rewarded as shareholders. Again, similar to some of the comments used earlier, what we find is managers don't look solely at valuation methodologies or growth methodologies. They look at both, right? I mean, if you're a value manager, determining its fair value and whether it's cheaper than that today, you have to make some decisions about growth. So you probably, all things being equal, would like a company that's going to grow faster. Some growth managers also want to understand kind of what they think that growth projections mean in terms of creating a current value. So when we talk about manager style, really we're talking about kind of maybe where their bias or emphasis is, but it's also important to understand that they're not looking solely through the lens of the stock evaluation of value or growth, solely buying cheap companies or solely buying expensive companies. They're looking at all of those fundamentals in their evaluation. On the bond side, a couple terms that you'll see kind of bandied about commonly are core and core plus. And I think, again, it's important to understand kind of what these terms mean because they do have some impact on performance in evaluation. The core segments of the bond market are investment grade, tend to be intermediate duration, and they are at a high level things like government bonds, investment grade corporate bonds, asset-backed securities, so bundled credit cards and car loans, mortgage-backed securities, and commercial mortgage-backed securities. So those are kind of defined as the core fixed income market. And that's where most bond managers live, is in that core space. You may also find managers that define themselves as core plus. And the idea here is that they're going to anchor themselves to the core sectors of the market, but through their investment philosophy, the prospectus they have, and the guidelines they have in place, they've given themselves the latitude to invest in what we would describe as the plus sectors of the fixed income market. And the plus sectors are really just the non-core sectors, right? So it's things like high yield bonds, international government bonds and corporate bonds, emerging market debt, floating rate debt. It's basically anything that is not in that core segment. And the idea behind core plus strategies is that those plus sectors may present opportunities for higher expected returns because you're deviating from that core investment grade segment of the fixed income market. But if you see a core plus strategy, it's also important to understand that that deviation, that kind of dip into the plus sectors, comes with higher expected risk levels at the same time. And so, if you're looking at your investment menu, oftentimes you find challenges where people are comparing the performance and volatility of two different investments that aren't quite the same, maybe a core manager and a core plus manager, and looking solely at the performance or at the risk of those can lead to some decisions that maybe aren't consistent with a full understanding of the investment strategies.
So we'll switch gears here a little bit. Talked a little bit about your responsibilities and some of the terminology that we use in the investment industry. In the next couple of slides, we're going to shift focus towards actual monitoring, monitoring of investment options, and some of the common tools that we use to support that function that you have likely hired us to support you. Two major categories of quantitative tools and qualitative judgment. So on the quantitative tools side, what our investment reports, our investment recommendation reports are really trying to give you both absolute and relative performance, total performance, and performance relative to a specific benchmark or peer group. We're going to work through some performance attribution, trying to dissect the performance. So not just that the performance was, let's say, 10% for the last year, but why did the manager perform 10%? What were their bets relative to a benchmark, and how did those play out to either add value or detract value for you as an investor? We're going to talk about risk-adjusted performance. Want to make sure that for the volatility associated with an investment, that it's providing an appropriate level of total return. So we'll talk about quantitative tools that we use within our investment reports and communicating to you our comfort level with an investment manager, but then also spend some time talking about the qualitative judgment that our investment team brings to the table as we review investment managers. So it's not just a monitoring investments from a pure quantitative standpoint, but really trying to use that as a tool to help from a screening and justification standpoint, but then also to overlay some qualitative judgment. And in this step, really, we spend a lot of time thinking about managers in three different buckets. So thinking about them from an organization and investment team and organization standpoint, understanding the philosophy and process that team intends to implement in an investment strategy, and then how those ideas and beliefs get put into a portfolio and how that risk is managed at the fund level. Really our goal with the qualitative judgment is to take the quantitative output and really try and understand, as the organization and process set up to allow us to say, we're comfortable that this investment process is repeatable into the future, and not just that performance was their performance, but we think that there's a decent likelihood that manager will be able to repeat that level of performance into the future. So before we get into the tools and the process for evaluating managers, it's really important to start with the benchmark. Benchmarks are really important. The selection of a benchmark is very important because we want that benchmark to be relevant to the opportunity set that a particular investment manager is using or investing in. So the benchmark really defines the opportunity or the set of securities, whether it be stocks or bonds, that investment manager is going to use to build a portfolio. So the characteristics that we look at in selecting benchmarks, again, flow through to those quantitative and qualitative tools. So we want to see that an investment, a benchmark, is investable. And by that, I mean, I could simply buy the benchmark. I could buy the benchmark return. Scott talked about passive managers earlier in this discussion. An investable benchmark is essentially I could go buy that benchmark and invest passively in the S&P 500. I want the manager to be accountable to the benchmark. So I want the, whether it be through a separate account agreement, direct agreement with the manager, or more likely through the manager's mutual fund prospectus, that the benchmark that we're using is either the same as they are using within their just defined within their prospectus, or it's substantially similar. We don't want to benchmark them to something that's completely different, because then attribution information becomes less relevant. We want the benchmark to be reflective of the current opportunities. So we want the investment manager to know what securities are in the benchmark that we're going to be used to measuring their performance relative to. We want it to be unambiguous. We want the securities, the type, the names of the securities and the weights of those securities to be defined and well defined in advance, so that, again, manager knows what they're going to be benchmarked against. We want it to be measurable. We want it to be calculated on a regular or a frequent basis, preferably daily, so that you can do daily attribution. This is not a real issue, given, over the last, 40, 50 years, the availability of pricing data has become greater. The ability to then calculate and measure benchmarks is much simpler and lower from a cost standpoint. We want the benchmark to be appropriate. So we want it to be consistent with the manager's style or objective. These kind of play off of each other, but again, the idea here is we wouldn't benchmark a growth manager against a value benchmark, or we'd want to know why we think they're a growth manager and they're using a value benchmark. Maybe that means they're not appropriate for the category or the role that we've hired them to fill within your plan. And then again, we want it to be specified in advance. We want that benchmark to start using that benchmark at the beginning of the evaluation period. So with benchmarks clearly defined, kind of the goals or the characteristics of those benchmarks clearly defined. This slide, we talk about some of the different benchmarks that are used in defined contribution plans. And you would see in our, scattered through our investment report. We typically use, 5 different sets of benchmarks across the asset classes that we offer, whether it be, S&P, Russell, which Scott's mentioned a little bit earlier, MSCI, Bloomberg, or NCREIF. Those first 4 being the most prevalent. But there's some interesting differences in their selection methodology that is important to note as an investor. So most of these are rules-based, and by rules-based meaning they have a set of rules that define the characteristics or the selection methodology. So as Scott talked about, Russell takes in simple terms, the largest 3,000 or the most liquid 3,000 stocks in the US, breaks them up into a large cap and a small cap based on the largest 1,000 go into this large cap, and then the lower 2,000 go into the small cap benchmark, and then splits them by different metrics or relative measures: price to book, price to earnings, into value and growth indices. So they have a set of rules that take a large pool of stocks and breaks them up into style specific indices that we then use in investment monitoring for benchmarking various investment managers. S&P does it a little bit different. They have a committee that then also is involved to select the stocks. So from time to time, you'll hear about up and coming stocks and how and if and when the S&P is going to be adding said stock to a particular index. And I'll show my age a little bit. And remember when Microsoft was just on the NASDAQ, and there was discussion of how does it go into the S&P 500 index. And so that was really important. More recently, as Tesla is grown, when does Tesla graduate into the S&P 500 to become more of a bellwether stock that's descriptive of the entire US stock market. So S&P does it a little bit different in having that committee. So there's a little bit of pressure to add or take away, stocks that are seen as very influential in the U.S. Stock market. Outside of the U.S., we use MSCI, Morgan Stanley set of indices broadly used for international equity investments, as well as environmental, social, and governance investments, both in the U.S. and outside of the U.S. For fixed income, we're using the Barclays Bloomberg indexes, and those are broadly used for fixed income. On real estate, if it's a private real estate fund, so a fund that's investing in direct commercial properties, there's an index put out by the NCREIF group that is a little bit different in the sense that it's not a set of individual securities that make up the index, but it's a peer group based index. So here what they're doing is they're taking managers' returns and creating a median essentially of that peer group and defining that as the benchmark. It's a little bit different, it's a little unusual. It's not an asset class that lends itself to some of those characteristics we talked about on the prior page of being well defined, having price discovery relative to, say, a stock index.
So, as David had mentioned, quantitative tools are one of the techniques we use to select and monitor investments. A key input in using those quantitative tools is the benchmark that's assigned for comparative purposes. Additionally, those quantitative tools frequently use manager universes or peer groups as an additional tool in the quantitative evaluation. The idea with these manager universes or peer groups are that you can group together multiple investment products or investment strategies that have a similar either stated investment objective or based on observation have similar portfolios of securities. These peer groups can serve as a benchmark because you can build the peer group, add all the managers to that, and calculate median performance, average performance, and other metrics to see how the average or median manager may have performed relative to your chosen strategy. From our perspective, we would define these peer groups as kind of a secondary performance measure. If we go back to the attributes that we think are really successful in selecting a benchmark, that it's clear and unambiguous, that it's known in advance, and that there's transparency as to the portfolio, peer universe, peer benchmark comparisons are trickier because that peer group can change over time. Managers may stay or move in or out. You don't know what their portfolio is going to be. You don't know what their performance is, but it can give you a sense of what the opportunity set was. If you're using the example of a large cap growth manager and you see how your manager performed relative to its chosen benchmark, that peer analysis, whether it's in the top quartile, second quartile, bottom quartile, gives you a sense of what other similar managers might have been able to do in the same time frame. Again, relative to the other tools, the other benchmarks, specifically in benchmark index, we think this is a secondary manager or a secondary measurement tool. And there's some limitations to this if you're looking at manager or peer universe relative metrics. For one, there's no adjustment for risk. So if we go back to the discussion I had just previously about core and core plus fixed income strategies. Up until a couple of years ago, if we look at Morningstar as probably the most prevalent manager peer group constructor in the universe, they had a single peer group for managers that were both core and core plus. They were all grouped together. And if you looked at core plus managers when bond funds were doing well, they all outperformed the core managers. And when bond funds did poorly, the core managers outperformed the core plus managers. There was no adjustment in most of those metrics for the relative risk of the different managers that are all grouped together. Additionally, kind of as part of that, one of the limitations is you're subject to how you define those peer groups. And you find that there are different definitions for what a manager is based on, again, what their stated objective is versus what their portfolio looks to be if we look at it historically. Morningstar might define something differently than Lipper or eVestment or other kind of database providers, or even how the portfolio manager may define themselves. Frequently, we find a manager that's maybe floated into the growth box, and they say, no, we're benchmarked to a blend benchmark, a core benchmark. We don't agree that we're a growth manager. We don't think this is a relevant peer group. So there's some issues with the definition. The other issue that we find frequently is it's somewhat subject to survivorship bias. If you're comparing your peer performance to the averages of other funds, you're only comparing yourself to the funds that have survived over that evaluation window. Funds that were unsuccessful, that merged away, or that closed don't live within that index, within that peer group over time. Kind of similar to that, depending on the asset class, those peer groups may not always be a perfect opportunity set representation. Small cap equity investing is a common area that we struggle with, where there are the peer group definitions of what a small cap manager may be, but the opportunities that are investable today for new investors is different than the opportunity set. Many of the most successful small cap funds are closed to new investors because of capacity issues. And so they show up in the peer group, but when you're making a decision about investment choices, a subset of that peer group may not be investable to you. So peer groups can be a helpful tool to provide context to your evaluation, but from our perspective should be used in a secondary basis to a benchmark comparison when you're using quantitative tools. As David talked about previously, the quantitative tools that we look at are really anything performance-based. Their absolute performance, their relative performance to a peer group or to a benchmark. They may be risk-adjusted performance, so there's different metrics like a Sharpe ratio and other terminology that adjust performance for risk. But it's basically anything that's using the historical performance to make an evaluation of an investment strategy or investment product. Oftentimes, these are the most common things that committees see because it's easy to get that historical data and put that together into a report that tells you a lot of what has happened. In some cases, the quantitative analysis can provide useful information, but there are limits to it. I think everybody's familiar with the disclosure that gets slapped on every investment advertisement that past performance is not predictive of future experience. That statement is there because it's true. So looking solely at past data, historical performance, and trying to extrapolate from that historical data what's going to happen in the future may not result in the outcomes that you want. There's actually been a lot of research that shows that the top performing managers in a given market are evenly distributed across the quartiles in the subsequent market, or oftentimes underperform. If I look at a very narrow window, I can go back as recently as 2020 and 2021. The managers that did the best in early 2020, when the market was down and COVID hit, were not the managers that did best in the subsequent period as the market got comfortable with COVID and bounced back. So looking solely at that historical data isn't very predictive of what's going to happen. There's some other limitations with respect to the quantitative tools. Similar situation where the analysis window and the benchmark or peer group assignment can lead to differences in kind of how a fund may look on a relative basis. Again, if I were to look at that kind of sharp market decline and recovery perspective, depending on how I define my analysis window, a fund may look overly attractive or overly negative. I know a year ago, we had managers that basically, if you look at a 1 year window, oftentimes in a performance report, you look at quarter, 1 year, 3 year, 5 year, 10 year. There was a 1 year window that basically dropped all of the negative market performance from the quarter prior and had all the positive returns. So you had some managers that were up 95% in the small cap space. That analysis window probably wasn't reflective of people's experience, because if you just rolled it back 3 months prior, you had a 50% drop and you averaged that out. So some of the managers that looked best, if you only saw the upside, if you evaluated them over a longer cycle, you saw the steeper drop may look only average or even below average, depending on how you define that analysis window. The other challenge is that some of those quantitative tools may not capture a current manager's strategy. Managers change their approach over time. And again, because we're using historical past data, it may not be reflective of what a manager is going to do prospectively. There's a large cap growth fund that is pretty prominent, one of the largest mutual funds and defined contribution plans these days, had a manager transition here this past fall. So a longtime portfolio manager, very successful, a new manager came in. It's expected that there's probably going to be some changes in the investment approach and the security selection decisions that are made. Looking solely using those quantitative tools at how that fund did isn't going to capture the fact that the person that made all those decisions is no longer there today, and that a new person's making decisions about how the fund may be managed in the future. So from our perspective as a fiduciary, it's really important to understand that there's a role for the quantitative tools. You're going to see them in your quarterly reports. You're going to see them in your Morningstar star ratings or your fundamental performance reports that tell you how a fund has done versus its peers or benchmarks. But from a prudent fiduciary perspective, it's not sufficient to just look at the historical data to make decisions. And that's where I think the qualitative judgment and the qualitative evaluation really comes into play. It's important to understand not just what happened, but why it happened. And while some of the quantitative tools like performance attribution can give you some of the data, it's really important that you are doing the qualitative due diligence to understand what's going on. And as a firm, when we think about qualitative due diligence, we really kind of break it down into these 3 areas. The investment management team and the organization, their philosophy and process, and their processes for portfolio construction and risk management. And as we look at this in each one of these areas, what we find is that there's a set of questions that I think are really important to be able to answer about any investment strategy. So if you're going to invest with an investment management firm, you want to understand how that firm is structured, who owns it, are they publicly traded, are they a private partnership, are they owned by an insurance company, a bank, who owns it? There's not a right answer to that question, but it does create some differences in how you may evaluate that firm and some of the resources they have or some of the challenges that they may face as they move forward. Continuity is an issue. Again, as I mentioned, a manager transition on a very large fund here. We had to evaluate, the resources they had to provide continuity through that management. It is expected these are people-driven funds for the most part. If you're not talking about indexes, people are going to be promoted. They're going to move on. They're going to retire. What's the continuity process look like? For that firm or for that investment strategy, what is their assets under management? Both the absolute level as well as the trend line. Revenue in the investment management space is driven by assets. The assets are growing. There are more resources to be invested in research and in portfolio management. If assets are shrinking, that can create some resource constraints for an organization. Again, understanding the structure of the team. Is it a team-based investment decision-making process? Is there a single manager? How are decisions made? Where do they get their support? Are they doing their own fundamental research? Or they have an analyst pool they're working with? Are they using outside resources? And what are their qualifications? It's really important to understand who is involved in the process and the support they have as an organization. And then once you understand that, you can get into what their philosophy and process is. What do they believe? How do they think they're going to be able to outperform all the other participants in the market that are trying to do the same thing that they are doing? What is their unique informational advantage that allows them to outperform? And how does that impact the implementation and construction of their portfolio? At a high level, we want to understand idea generation from, there are thousands of individual stocks out there. How do they decide the ones that are going to end up in their portfolio? What's the process that they use? And how has that process been designed to make the positive outcomes that we've probably seen historically likely to be repeated in the future? How do they analyze ideas? How do they evaluate those? Who's involved in that? And how do they ultimately decide to buy and then eventually sell individual securities in their portfolio? Understanding that philosophy and process, you then get into the specifics of portfolio construction and risk management. What benchmark do they use? What constraints have they put in place on a fund, cash limits, industry, sector positions, country level allocations? How do they define and measure risk? And how do they make sure that the portfolio is consistent with that philosophy and impact? Those qualitative evaluation criteria are really important to understand why a manager has performed the way they have. And another example, I guess, that comes to mind is we have a number of clients that are using a small cap value manager. That small cap value manager is a kind of a boutique team that runs a quantitative portfolio that has a computer model that's really built to identify high quality companies in the small cap value space. As part of their inputs, they focus a lot on profitability of the companies they invest in. If you've been following the market over the past couple of years, the meme stock trend has really kind of popped up where companies like AMC were, taking off through the roof. And a lot of those companies were in the small cap value segment of the market. And so as we looked at the relative performance of that fund, we saw that the fund lagged for an extended period in 2020 into 2021. Understanding how they build their portfolio, what their philosophy is, and how that translates to portfolio construction gave us the ability to then be able to compare their performance to the broad market and understand what was driving performance in the market. During that same period of time, I think it was roughly a third of the small cap value stocks in the benchmark had no profits. And those were companies that if you looked at which stocks were performing best over that period of time, they were the ones driving the market higher. So understanding the qualitative, how this manager manages the portfolio allowed us to then look at the quantitative data, understand the performance, and make decisions that the manager's doing what they're supposed to be doing. Long-term, they have been able to add value through that. Currently, the market is rewarding a different type of stock, but long-term, we don't think the market has rewarded those. It's worth staying with that fund versus selling out of that manager, buying another manager that may be invested in unprofitable small cap value companies and chasing performance. So the qualitative due diligence, I think, is really important to understand the quantitative and to make informed decisions, either to buy a manager, potentially to stay with a manager who's going through some period of underperformance, or to ultimately decide when something's changed about the way that they're doing things and it's time to get out of that fund. The last thing that I just kind of wanted to touch on is, we talked a lot about the quantitative tools and the qualitative tools. The last thing that I think is really important to understand is in the defined contribution space. Again, there's a lot of complexity. And as a fiduciary, I think it's important to try and simplify and understand what's going on. The investment vehicles that we talk about can come in many different forms. And as we look at this, kind of break it down into a few different groups. First are general accounts. These are most common for 403B or tax exempt plan sponsors, as well as for record keepers that are an insurance company record keeper. A general account basically is a fixed investment where it may be offered in your investment menu. You give your money to an insurance company. They pay you a fixed rate that they get to determine. And that rate changes as interest rates change. And the insurance company basically makes money by investing the money you gave them and earning a higher rate than they pay you. Those are a common investment vehicle in, again, insurance company record keeper plans, as well as tax exempt plans. They require, because of some of the credit risk of the insurance company and the lack of transparency, their own set of evaluation. Aside from those general account products, within a defined contribution plan, you'll typically see 4 different types of investment vehicles. You may have all of one type or a mix of these, depending on the size and complexity of your plan. Typically, they're all different avenues to get the same thing, which is some sort of pooled or portfolio management. Most commonly, you'll see mutual funds. Mutual funds are offered by prospectus. They're overseen by the SEC. They're available to retail and institutional investors. You own shares of a mutual fund, and there's a lot of data available on those. There's public databases like Morningstar and Lipper and others. You can pick from basically any of the options that are available in the mutual fund world. You may take an individual strategy. Again, maybe it's a large cap value strategy and it's available in a mutual fund form. It may also be available in a variable annuity. Again, these are offered primarily the variable annuity and the general accounts by insurance company record keepers. It could be the exact same strategy as a mutual fund. It's just a different wrapper, a different construct. Typically, that wrap structure of the insurance may add a layer of fees, but it may be part of a record keeper, insurance company record keeper kind of bundled platform. More frequently, we're seeing the advent of commingled funds or collective investment trusts. These are available only to institutional investors. They're not available for retail investors. They are pooled. Multiple plans come together and pool their assets, but they're all typically institutional retirement plans. There's a kind of a streamlined compliance structure to them because they're not available to retail investors. They are typically a little bit more stable investor base because they're institutional versus retail money. And because of the streamlined compliance oversight, the limits not having to market and distribute to retail investors, they oftentimes come with a lower institutional price. CITs or collective investment trusts are not available to all plan types. 403B plans currently can't use collective investment trusts, but for those plans that can use those, they are becoming more common and more frequently used. They actually, though, come with some additional paperwork that is, it's sometimes a surprise for plan sponsors. And last, for largest plans available separately managed accounts, you could actually go and hire a manager to create an individual portfolio for you. That may be available as well.
Great, Scott, thanks. As we just wrap up this discussion, want to thank you first for spending time with us. If you have questions, feel free to reach out to either Scott or myself or your specific consultant here at Multnomah Group. But what we'd leave you with here is we hope you have a better understanding of, one, how you meet your fiduciary obligation with related to investments, and that typically is done through hiring an external service provider like Multnomah Group to provide you with fiduciary level investment monitoring and selection support. We talked a lot about some of the jargon or technical terms within our industry, but we hope you have a better understanding of the difference between strategy and style and techniques. And you have this document and potentially this recording to give you some further clarification as time goes on. And then ultimately, part of the prudent process is really around benchmarking and making sure that you document the rationale for the retention of the investment options that you offer to participants. And I would say the last thing is when you're confused, ask questions. That's what we're here for as consultants. We love to answer questions. It demonstrates for you a good committee process and not just accepting the recommendations that are offered to you by your advisor, but really it gives you an opportunity to ask questions and to show your involvement in that process. With that, I'll just say thank you again for your time today. You will get a copy of this recording sent to you via email in the coming days. Appreciate your time and enjoy the rest of your day.